end of the day, the cost of that debt, yes, will go up, but it's effectively they're looking at the total return they're going to deliver. The fact that it goes up, it's going up relative to other investment returns going up.
It's going to limit your gearing though, isn't it? At that point, if rates go up, if cap rates stay the same, which would be unusual, but if they did, then you're going to be very limited on gearing. I mean, we see, we were doing loans like everybody was in 2006-07 with ICR at kind of 110, 120, which is clearly lunacy, but we will do it. We don't see ICRs now of probably less than 190, 200 on anything that we look at. But obviously, sticking up 2.5% on the interest rate, clearly the effect that's going to come down, and that's going to limit people's desire to gear more, I would suspect, because banks you're not going to want to do it. We're not going to want to be in a structure, even if we're not lending. We're not going to want to be in a structure where the ICR's so skinny, even if you're taking all the risk or another fund's taking all the risk.
And ultimately that will
falling over, isn't it?
Will dictate where LTV
I think
can
so.
get to. I think increasingly people are pricing the cost of debt much better. I think that there's a danger that we are starting to move to a market where perhaps increased LTVs are not necessarily priced because as they go up, so margins are coming down, and there's a point at which perhaps it's getting a little bit too close that people are not fully reflecting the risk that they're taking. But clearly, I think this is where the days of assuming that you could just put large amounts of debt into transactions, I think is we're a long way from that, coming back to that market again. So yes, it will influence pricing as interest rates go up. I think the reason people are comfortable at the moment, interest rates are not going to go up rapidly. If there was that fear, I think it would seriously impact into the pricing of real estate, but that's not at the moment taking place. The people are relatively comfortable in the medium term. Interest rates will stay relatively low.
I think, as I say, I think the issue is if you're a fund or a seg mandate, you tend to price, as you rightly say, Philip, on a total return basis. And therefore, what the underlying interest rate does is a little bit like the surface of the sea versus what's on the undercurrent of it. So the surface of the sea will remain relatively static, which is your total return. What goes on underneath it is kind of irrelevant. And it actually may work very well for some borrowers and lenders because at the end of the day, they're still going to face the same total return expectations, and the underlying interest rate is not going to make a lot of difference to either party. So it then becomes, what's the impact on the property market, at cap rates, and the rental growth scenarios? And that's the crucial part, in my view, because at the end of the day, another 1% on interest rates sounds horrific when we're at half. That's a 3 times increase. But if you're still only 1.5% plus a margin, it doesn't actually impact your capacity to borrow a great deal. If you suddenly said 0.5% LIBOR swapped ends up at 7%, as we've had in the past, that's big. But I don't think we're going back there for a very, very long time that we could foresee. What it makes the availability more difficult is that the investors who are putting their money into the funds have alternate sources of income. Because if the rest of the market has gone up, the fixed income market, corporate bond market, are producing higher returns, and you're still here, and they're coming up, so your illiquidity premium is eroding rapidly. And that, in the longer term, threatens the existence of new funds and seg mandates coming up.
Because it's going to be easier for them to go into bonds, fixed return, rather than take what they would then perceive as an additional risk by going to real estate.
Correct.
Whereas at the moment they're getting paid for that risk.
We've seen this in the States fund enough.